Let's connect with Sandeep Sabharwal as well, who's with us on the show. Hi, Sandeep. Just a few more trading days to go, and then we'll be ushering in a brand new year. Given the fact that the FIIs have been selling, we have seen the markets come off quite sharply. What is it that you think this spells out for the new year ahead?
I think in the new year, if we start off with a base which is much lower than what was there 6 months back. For example, I think in the last 6 months now the markets are down. The first 6 months of the year were good for the markets. Then, although the broader markets continue to do well for some time, then the overall market has given a correction. Now, as we look into 2025, we shouldn't be too bearish because there are a lot of factors which seem to be peaking out. For example, the sentiment for US equities is at an all-time high. The US dollar longs are at an all-time high. People are extraordinarily bullish on those. And typically, when that happens, normally some sort of reversal trade will follow. US accounts for an extraordinary part of global market capitalization now, and the consensus is that US will continue to outperform. That actually might not be the case because the valuation difference between US and other markets has increased substantially. In the Indian context, we've had a growth slowdown due to various reasons, tight liquidity followed by various restrictions by the RBI on credit flow, which obviously restricts economic growth, then the elections, heat wave, delayed monsoon. So I think there were a lot of factors at play, and lower wage growth relative to inflation has also impacted consumer sentiments. Now, some of these things are likely to moderate in 2025. So although because of what market is doing right now, many people are bearish, I think we could actually see a decent year 2025.
When you say decent, will it be better than this year? Because this year also has been quite decent. The returns, Sandeep, have been in line with averages.
So if you look at large caps, I think 8-9% return this year is somewhat lower than long-term averages of I think 14-15%. Last 20-year average has been I think around 16-17% if I'm not wrong. So we are much below that for this year. So next year could be better than this in my view on a overall, if I look at it on overall basis. So I would think that a range of 10 to 15% return for the Nifty should be likely. Broader markets is a tougher call because they have outperformed so much versus the Nifty, both in terms of the mid cap and small cap indices. So the overall indices next year is a tough call, although in a monetary easing cycle, small and mid caps tend to outperform, but they have outperformed when monetary easing was not on also. So next year will be interesting to see out there. So obviously specific ideas will and stocks will remain, but it will be tough for the broader markets to outperform the Nifty so much.
Realize that, Sandeep, you're right. I forgot to delete last week's 4%. I remember checking the data 10 days ago. 10 days ago it was 12, and now 12 has become 8.5. What a difference 1 week can actually make. So much so for a year of high event, high volatility, and 8% if you got this year, you are in line, actually below averages, and this is not what appeared would be the year close in October, November, when markets were really roaring. So October, November, and last couple of days have really taken the zing out, so to speak. So Sandeep, if 15 to 18% is what you are expecting in terms of a Nifty return, give us a list or some names where you expect that the return could be 20 plus, which can beat the Nifty return by 15-20%.
So I said 10 to 15% would be the Nifty expectation. So 15 to 18% would be at upper end and will require a lot of positives to kick in, which you need to see how that goes. So if you look at the overall construct of the markets today, uh, I would think that stocks which could outperform the Nifty could include stocks like L&T, which has been performing much better than most other companies and has the order book to sustain growth. We could see some of the banks stage a comeback. Axis, ICICI, Kotak. I think HDFC Bank could also do well, but I would think that these three could outperform. Then it's possible that if uh, the festival season and the marriage season does well, then some of the auto companies could stage a comeback. So stocks like M&M continues to do well. So we continue to hold that. I would still think that should be able to outperform the markets. From the stocks which have corrected, I think Bajaj Auto looks interesting after a 30% fall from the top because they could benefit if the rupee potentially is weakens more next year than it has weakened this year because RBI is controlled so much because of its export markets and on its EV foray also they are doing much better than what they were doing earlier. Bharti Airtel again continues to do well, so that's also corrected. So I think that could also do well. And as dark horses, some of the consumer names, if consumer sentiments improve, most of the large consumer names, they could, I think, easily give 15-20%.
Consumption, Bajaj Auto, M&M, Airtel, these are some of the names that you can look at perhaps in correction. But Sandeep, what do you make of the news flow over the weekend or lack of news flow from that GST meeting? I mean, the important ones on ATF, gas, insurance got deferred. What we did get was changes on popcorn as well as the used cars. What do you make of all of this?
Oh, so I don't know what to make of it because no major decisions were taken at all. So uh, the point is that I think there is a clear inclination to tax more wherever they can and not provide relief where relief can be given. So I think across the board, GST rates are restrictive in India. So when you compare, so people say that many countries have similar income tax rates like India, India is at the upper end with most of the other countries. But then if you compare the indirect tax rates in many of these countries, for example, VAT across the board in US states ranges between 5 to 9% broadly. In India, GST rates vary between 18 to 28% on most of the products. So I think those are restrictive rates, but there doesn't seem to be any inclination to moderate these rates at this stage.
What does this mean for consumption? Because the mass end of the category is still reeling under pressure, right? Urban and in the sense the luxury side is doing okay. Does that mean that the slowdown in the mass consumption is here to stay?
As of now, revival looks tough. Like there could be some revival this quarter seen because of festival demand and farm incomes coming in post the harvest and farm product prices have been good. But on a sustained basis, whether we can see a consumer revival or not is tough to say immediately. Eventually, we will see a revival because if the economy is growing at 6-7% and we have had 2 years of very subdued consumer growth, then eventually there is a comeback. So I think same time next year, we could be looking at a much better picture. Near term still looks hazy.
Naresh, go back to that same point again that we are in for a gap up start today of about 150 to 170 points. Will that sustain and what should one do? Because this week A, it's truncated and B, it's expiry.
So I would expect it to sustain at least, say, the 200 pointer bounce back. But the fact is, at least we need to go back above the previous highs of on Friday. That is still far off above the 24,000 mark, which is where we've gapped down in the last two sessions. So that is still quite a say 400 points away from Friday's close. So overall, even if we get a mild day with a 150, 200 pointer close, that would be a decent enough place to start off a recovery even. Overall, the simpler part is to look at 23,200 and say 24,200. Those become the two pivot points for the markets going forward. Like earlier when we broke 24,200, we got a 500 pointer plus move. And now going forward, this is a 1,000 pointer range. If that shifts, then we get into a bigger trending move.
Good run for real estate stocks, very good run, and especially for the smaller ones also. And that is one space where there is no iota of slowdown. Economy may be slowing down, but real estate builders and developers are telling us a different story. Will this uptrend in real estate stocks continue next year as well?
Nikunj, I would think very tough for this to sustain, simply because of the fact that too many of these real estate companies are excessively bullish now, and the supply increases are rapidly piling up, while it will be very difficult for demand to sustain at this level. For example, last few months we've already data indicates already there is a slowdown in demand. So the company managements of most of the industries tend to get most bullish when the cycle is doing very well. And I would think that we should be cautious on real estate stocks, at least for 2025. The long-term cycle could still be potentially intact, but in the short term, all positives are in the price.
When it comes to the entire auto basket, there have been a number of new launches, but do you see that the passenger vehicle demand is going to hold up? What's the sense that you're getting as well on EVs, and who do you think is going to be the big leader in that space?
So auto demand obviously has been subdued in the near term, except for the month of October when retail demand was October, November retail demand was strong, but again December, as per the data coming in, it's again a mixed picture. Now, auto demand depends on various factors like one, consumer sentiments, how good they are, at least for urban demand. Rural demand could hold on because of good crop prices, etc. And to that extent, it's a mixed picture. But most of these stocks have also corrected 20 to 30%. So I think there could be value in some of the stocks. But on the EV side, I think on the four-wheelers, EV adoption still is slow and could remain slow for some more time. It's two-wheelers where the adoption is aggressive and where the legacy players are also pushing aggressively on making the shift happen and also gaining market shares. So I think TVS, Bajaj Auto seem to be leading as far as the legacy players go. Obviously, there are other companies who are purely into EVs like Ola Electric, etc., where I wouldn't be so bullish. I think they'll continue to lose market share.
Bajaj gets a large amount of revenue from exports. That's 30% broadly. And Nigeria is one of the large markets. And I remember having a conversation with Jim O'Neill, and he said that for me, it's going to be India, China, and the dark horse for next decade could be Nigeria. I don't track that economy that well to offer a comment, but I'm just telling you what Jim O'Neill in a sense actually had told us. And if that economy does well, then Bajaj Auto significantly could be in a position of advantage, so to speak. There's a whole buzz about duty protection coming back for steel. Steel, unfortunately, has not gone through a good patch. But Nuresh, is there a trade in any of the steel stocks? Because they've been more like yes and no kind of stocks for this year.
So we've not seen a large correction per se if you look at the steel names. So Jindal Steel, which has been the leader, say 1,050, 1,080 has been the top. It is down to 900, just a 10-15% correction, just like the markets. You look at a JSW Steel, the other one which is mainly affected. I actually saw the correction only in the last 2 weeks. The stock was closer to the all-time highs just 3-4 weeks back. The only name which has really seen a correction in a larger way is SAIL, which has corrected from 175 down to 115. So if somebody is looking out for a trade on the basis of this, it has to be SAIL, which has corrected a lot. But overall, if you look at the larger steel space, we've not seen a very sharp correction per se. So for now, this does not become a great trade. If one is looking out for a bounce back trade, it would be SAIL at 110, 115.
Be a bounce back trade, but since we're talking about metals, Aditya, specific view on Vedanta, that stock is going to be in focus because they've decided not to demerge the base metal business, which means that now the company will be demerged into 5 entities versus 6. But Street believes at least it's a step closer to demerger now, given the fact there were questions being raised about the base metal business. So it's chart check on that one. And secondly, JBM Auto bagged a large order. What do you make of the prospects on chart of that one?
Right. So when we talk about Vedanta, then it has been one of the leader, whereas other stocks have underperformed. This stock has outperformed. We'll follow level-based approach over here. The stock is trading at 477.25 currently. If the stock crosses Friday's high, that's 495. That would be bullish. Stop loss should be placed at 475, and target should be 530 to 545.
Okay, and you do have a pharma pick for us as well. Glenmark is something that you're positive about, Aditya.
Pharma has been doing well and acting as true defensive pack when the market is falling quite a bit. So Glenmark is buy at 1542, 1499 is the stop loss, and 1585 to 1600 is the target.
Naresh, we were just talking about a little bit of an imminent slowdown within the entire consumption space. But if you had to do a reading on the charts, which are the charts that you foresee some sort of a, an evidenced slowdown?
So the whole FMCG pack, the recovery which we saw back in from June election lows has been fizzled off, and also the price action has taken them back to the prices where they were, say, 1, 2, 3 years or even 6 years back. So if you look at a Dabur, the stock used to be 480 back in 2018. We are at 500 today. You look at Hindustan Unilever, the largest name in terms of that, the stock is back to the prices where it was in April 2020. Even now, we've started seeing some bit of a pause in, say, FMEG names also. We've seen a pause in Havells, etc., wherein they've seen a pause. So overall, consumption as a basket has taken a pause. But there could be an opportunity if we see another 10, 15%, 10% plus correction in the FMCG pack, because that would make their 3, 4, 5-year return zero. And that's generally a good point to start in a defensive stock.
Talking about the stocks which have been defensive or haven't given much return, Sandeep, what about Reliance? Do you think it can make a comeback in 2025? Morgan Stanley this morning has added Reliance to their, Asia Pacific focus list, and they've removed GAIL. Do you think 2025 will be better for Reliance and perhaps some value unlocking that we've been talking about?
So value unlocking, I'm not sure, because I think Reliance is not inclined to do demerger and listing of its subsidiary company, which many analysts keep on expecting, but it doesn't happen. So I think on that front, I'm not sure. But on a pure valuation basis relative to historical valuations, as well as the correction from the peak, which it has seen of around 30%, it falls into a bracket of a large cap company, which should be bottoming out imminently. So I would have, like, from 1300, I had thought that now the stock should bottom, but it's continued to correct as the market corrected. So overall, from a return perspective, I think Reliance is decently placed both on valuation as well as prospects, because many of its businesses could bottom out in the near term.
What about the debt? I mean, they were on course to become a zero debt company, but look at what all they've added. What they guided, let's say in 2018-19, of becoming zero debt, somehow that promise has just faded away.
Yeah, so I think that's been my biggest concern for Reliance, and that's why we never actually bought into Reliance for many, many years, because they continued to guide for zero debt, but then they kept on adding new businesses, investing more, and as such, there was no free cash flow. But with a fall from 3,300 pre-merger, bonus to a 2,400 level now, I think many of these concerns are in the price, and we need to, and many of the businesses which are still currently operating also saw stress on profitability, like oil to chemicals as well as retail, etc. So I would think that many of those businesses could also be bottoming out. So when the performance bottoms out, typically from there the stock should ideally outperform. So I think similar debt concerns could be there for many Adani Group companies also because they have in fact built more debt than Reliance. But that doesn't seem to be the concern of the market. So I think uh, the debt and the lack of free cash flow concern was always there. It's just because the stocks corrected now, it's getting more highlighted.
Let's actually look at another stock where we've seen dynamics change. Cash flow was always strong. The dynamics have changed, and that is Asian Paints. The year or the current year will be like one of the most brutal years for Asian Paint shareholders. I mean, barring COVID and extraordinary years, but 30 to 33%, I frankly don't remember when did Asian Paint fall like this. Sandeep, everybody now knows that competitive intensity has increased and there is going to be market share loss. But at the current level and after 30% decline, is Asian Paints pricing all the negatives?
I think there are three phases of a stock bottoming out. First is denial. So I think most of the long-term holders of Asian Paints were in denial that this could happen. So I think that denial phase is over. Now we are in the acceptance phase that yes, this is their profitability will suffer and uh, competition will impact them. And then there'll be a phase of despair sometime in 2025 when many of the long-term holders will get frustrated and sell out. I think that will be the time to buy. So exact levels are tough to predict, but they could be 10 to 20% lower than the current levels.
Okay. Another stock which I'll discuss both with Nuresh and Sandeep is Bajaj Finance. Now, while I looked at their analyst day notes and they are talking about a 20% plus growth, AUM growth also, that kind of, also decent. But in last 3 years, the stock actually has been flat. It got this elevation post-COVID and after that it has remained flat. Nuresh, could 2025 be the comeback year for Bajaj Finance?
So if you look at Bajaj Finance, it had a massive run back in 2010 to 2020. And post that, a lot of financials which were, say, expensively valued have gone through a 3-4 year consolidation phase, whether it's a Kotak Bank or a HDFC Bank or even Bajaj Finance. So for now, we are in that consolidation phase. Tough to call out when it gets out of this. So if you look at the price range is also reduced. So the stock on the lower end has been 5,500 back in 2022-23. On the top end, 8,000 has been a problem, and that has been attempted maybe 6-8 times over the last 3 years. So after topping out in mid of 2021, the stock has not been able to sustain 8,000 odd levels. Very similar to that 1,800 mark in HDFC Bank, which still continues to be a problem. So this is the stage where we've seen longer consolidations, and it's tough to call out. We've seen Reliance also go through a 6-8 10-year consolidation back in 2012 to 2018. So for now, the case is on the lower end, 5,500 is where you expect a base. The near-term last 6-8 month base has shifted to 6,300, 6,500. So if somebody is bullish, one could look at 63, 6,500 as a good starting point. But does it go above 8,000? It's too early to call.
All right, it's 9:01. Let's thank Sandeep for joining in and find out what those top mid-cap recommendations are from our chartists. That's the pre-open rate. That's on your screen. It's indicative of a positive start and just about flat, I guess, given the kind of movement that we witnessed on Friday. Will be interesting to see what the rest of the week holds out for us. So, Nuresh, let's get in your top mid-cap call.
So that would be a buy on Lemon Tree. The stock has made a strong comeback from that 115, 120 mark. Volumes kept on increasing. And the stock almost came back to the previous highs and all-time highs is very close. We've just seen a tick above those. And we've seen a much higher move across the whole hotel pack. So out here going forward, I would expect Lemon Tree to take leadership. So buy at current levels with a target price of 180, stop loss at 147.
Okay, so those are the top recommendations coming in from Nuresh. Aditya, what about your recommendations this morning?
Yeah, so I have chosen Oro Pharma. In last few days, Pharma index has done very well, and they were attempting a breakout, but then this correction started. And I think now post a flat opening or decent opening, Pharma could again continue its rally. So I like Aurobindo Pharma, which is a buy at 1242. Stop loss is 1210 and target is 1274 to 1290. So that's the first pick. And second one, ITC, which clearly stands out in this volatile market. That stock is still doing well. And on Friday also we saw decent recovery from the lows. So that looks good at 465. It's a buy. Stop loss is 457. Target is 473 to 479.
All right, thanks for those recommendations.
If you like this video, then like, share and subscribe to ET Now.